What's going on, everybody? 360 Digital Closing Bell here. I am your humble correspondent, Michael Tanner, joined for our week ahead podcast here on a beautiful Monday, June 8th, episode number 23. We are live from an undisclosed location here in Denver, Colorado. As always, we are joined by the executive producer of the show, the purveyor of the show, and the director and publisher of the world's greatest website, oilandgas360.com, Stuart Turley. Stu, how you doing today?
I'm doing great from an undisclosed location. It's a beautiful day in Dallas.
It is a beautiful day. We're recording this on a Sunday afternoon here right before the markets open. So if you're listening to this, markets are still closed. It was a little cold this morning in Denver. And just an update, I'm playing sore today. Lots of yard work happened this morning. So I am playing sore. Forgive me on this if you don't see any of the antics. But we have a great show for you guys lined up. I mean, we're going to really dive into Friday's wild trading day and kind of break down what happens and maybe what that means going forward. As always, we're going to cover the levels for crude oil. We have some crazy international news stories that Stu's going to get to, and always we will check in on the 360 official, non-official fund. But first, are you asking the question, what is social risk? Because if you're not, you are falling behind, especially if you are an executive, because it's not just community opposition to development projects. It's everything from the success and the divest from fossil fuels movement to the investor engagement on your ESG programs to individual states setting ambitious climate and decarbonization agendas. It seems like it's everywhere now, and it's moving and it's multiplying like zombies. But guess what? Never fear. Adamantine Energy and Tisha Schuler, who are the leading consultants helping the oil and gas prepare for all of the social risks, are here to help. As I mentioned, Adamantine Energy is led by friend of the show and wonderful person, Tisha Schuler, who's the former CEO of the Colorado Oil and Gas Association. And what Adamantine is doing is they're helping your company explore your exposure to social risk, your options on how to respond, and how your peer companies are responding. And that's key, because it's not only knowing what to do, but also what your peers are doing, so that you can, again, navigate what's going on. It's public oil and gas. It's a cutthroat economy, and you need somebody like Adamantine on your side. Check them out, www.energythinks.com. She also has a great podcast that is just now launching. You can look at Energy Thinks by Tisha Schuler. It's going to be an awesome, really ESG thought leadership podcast. She's going to interview a wide variety of people from not necessarily the oil and gas field. That's what's cool. They're going to be from really outside the field and people looking on in terms of how ESG affects everything going on. So it's awesome. I checked that out. iTunes, Spotify. You can also look at YouTube. You should also sign up for her weekly newsletter, because your competitors are reading this. That's the scary part. If you're not reading it, your competitors are. You can check out. It's called Both Things Are True. You can sign up for all of this, www.energythinks.com. You can also subscribe to this podcast, 360 Digital Closing, but iTunes, Spotify, YouTube. You can follow Enercom and Oil and Gas on all the major social medias, Twitter, LinkedIn. You can connect with me and Stuart Turley. You can check out all of the Energy 360 interviews on the world's greatest website, oilandgas360.com. Today, 2 o'clock, as you're listening to this on a Monday, 2 o'clock, you're going to be hearing Heidi McKillop, right? Or is it going to be, are we going to drop that in the morning?
We'll probably drop it in the morning, but just sometime before lunch tomorrow.
Awesome. So we'll push it out on all the social media. That's a great interview. That was a great story about somebody who, wasn't in the energy business, but saw why the energy business was helping everybody around her, and really took a stand and wrote an awesome YouTube video. She's in that ESG space as well. If you've listened to this podcast before, we are a fan of ESG, that it pays the bills around here. So we are a huge fan of it. And we had a great conversation with Heidi. You can see that on all the socials. And then on Wednesday, you're going to be able to hear a great interview, another author in our sort of little series of authors we have going here. You can see it on the screen if you're watching on YouTube. But Buddy Clark, partner at Haynes and Boone, who's co-chair of the Energy Project, he wrote a book called Oil Capital. Thick book. Stu took the time to read like 2/3 of it, which is honestly extremely impressive. And we had a far-reaching conversation about it. Really, it goes back to, what type of sort of the oil and gas capital history looks like. I mean, he goes all the way back to the 1800s. We bring it all the way forward to 70s, and how some of this pro-racial stuff relates to what happened specifically in Texas when Haynes and Boone does. So it's a great interview. I highly recommend checking that out. It'll be dropped on all of the social medias Wednesday. Is there anything else I'm forgetting here?
I think you're good. We got more coming, and even after that, we're interviewing a few more authors and a few more other big folk coming right around the corner.
Yeah, we're working on getting a really cool authors page spun up, which I think will be really, really cool on the website. So stay tuned for that. We haven't announced this yet, but if you're listening to this podcast, we give you the inside scoop about everything. So yeah, we're working on it. Stu just sent me a link this morning to take a look at it about what it might look like. It's going to be awesome. We're workshopping the name still, so we don't need to lean one way, but it's going to be awesome. You're going to see all of our author interviews there. Before we get into to sort of the levels for the week and some of the things that I'm looking for specifically in U.S. shale, I think it's important to cover, if you what happened on Friday. Because if you listen to the closing bell, it was clear it was a wild day. XOP contract was up 11%, which is basically the index that covers all U.S. energy equities wrapped up into that fund. It was up 11%, which, if to give you an idea, the S&P 500 was only up 2.6%. So energy equities by far gaining. And to be honest with you, I think energy equities might have had some of their best days ever, specifically some of these stocks that we're about to look at. And I think it's important to cover why it happened, and then maybe what that means going forward. But I think it's important to first ask yourself and figure out, okay, well, how do you even price an energy stock anyway? And maybe not so much as how you would price an energy stock, or how are they priced by the big players in the field? Because I think there's always this balance of, okay, what do you think the right way to do something is versus, okay, well, what is 95% of the industry doing, and how is that affecting the way these stocks move? Because yes, you might think that some of the ways that large, because this is a big criticism of energy finance Twitter, EFT. Their big news crack is the way we cover from an equity sell side perspective, the way we rate oil and gas exploration companies is all wrong and it's a scam. Well, okay, you can believe that. But if everybody on the equity sell side, which are the people who rate companies and tell you which way they're going to move, they're the people that say buy, sell, or hold. If they're all using this method to rate companies, well, I don't care that you think it's wrong. You might be right. You might even be right. And in some cases you are. But guess what? I'm going to use the method that the people who are actually moving the stocks are, who the institutional players are, who trade 80% of the volume, who they follow. So, you can, if you're big onto the old way of, monitoring and rating equities, if you think that's all a scam, well, this next part's probably not going to be for you. But if you can accept the fact that whether we agree with it or not, this is just how companies are priced in terms of energy equities. They're done numerous ways. First way is really it's pretty easy. Fundamentals and technicals. Fundamentals are basically all of the different types of, when you look at a 10Q or you look at a quarterly report, and all of those different lines: market capitalization, enterprise value, revenue, profit, EBITDA, net income, earnings per share, cash flow expenditures, free cash flow, all of these different fundamental numbers that tell you how much money they have in the bank, how much they've spent, all that coming in. So that's one way when you go to set the price of a stock, you look at the fundamentals. The other is the technical side, which is how is the stock doing relative to what it's done in the past? Are there certain levels at which it likes to hang around? Are there numbers with their price? Because when we think technicals, just think price over time and any sort. And the other big technical thing that we look at specifically with energy stocks is correlations, because clearly when you're in a commodities-based business and the majority of your revenue is coming off oil, well, you're probably going to be related to the price of oil. So I would encourage you, if you're not already, because if you haven't done this already, I would go to something like tradingview.com, create a free account. I would go create a chart and create and compare crude oil, which you can just type in WTI, and then you can click add, which is add correlation, and then you can type in XOP, which is our XOP, and I do a 6 to 10 year graph. And what you're going to find is, as you would think, this isn't groundbreaking news here, that the oil and gas energy equities contract pretty much mirrors and slightly lags what crude oil does. And that makes sense because companies don't quite see the value of full $40, oil's $39.55. Companies not seeing that in their bottom line. They have lifting costs, they have transportation costs, they have all these other expenses. They may see a number like 20, 10, who knows, whatever the number. Hopefully they're getting some positive numbers off this. Some of them aren't. It's why we're shutting in, but that's a whole nother story. So it makes sense that when oil goes one way, energy equities follow. And so clearly since really 2015, oil has been disastrously low. I mean, it's gone up a little bit, but it hasn't specifically been at levels that have really provided strong fundamental numbers, which is the way you price income. We haven't seen strong fundamental numbers really since 2015. And so really, so then, so if you're probably wondering, so Michael, the answer is simple, right? All of these stocks went up on Friday because oil went up 5%. Oil's now at $40. It's a bullish number. And you're kind of right. Yes, oil does have a big factor on the way energy equities move. And yes, over the past 2 weeks, crude oil has had a huge bull run. But we've seen energy equities stumble throughout that time. We've seen S&P go up 3%. Energy equities down a percentage point. If you've been following the closing, I encourage you, if you're not listening to our 5 to 10 minutes, really turn it into a 10-minute show, but our 10-minute sort of daily summary of what's going on, of what happened in the markets. We try to give you sort of our one big thing, and that's sort of the stories we pull from when we put these larger shows together. So if you're not watching, I encourage you to do that. They're live on YouTube, 2 p.m. Mountain Standard Time. But one of the key things that we've been covering is not only this bull run, but if you've been watching, XOP has sometimes stayed flat. So, S&P's gone up. The S&P 500 is not correlated to the XOP contract. There's very little there is some, obviously. There's a percentage, and I think Trading gives away a free correlations widget. We'll have to put that on the 360 news desk, put a bunch of correlations. No, it's one big thing, especially if you're trading futures. Correlations are the big, if you're trading futures and you don't have a small screen doing correlations between crude oil, NASDAQ, S&P 500, all those futures contracts, gold, you're doing it wrong. You should have a commodities correlations and an indices correlations, because all of those indices play along, and you can really trade off lagging. You can really trade off these laggers. So I encourage you, look at correlations. But again, we digress. So it's not just so simple that oil went up, all of these companies then go up, because there was a huge discrepancy. Like I said, XOP contract was up 11.7%. The biggest gainer on the day, as we mentioned, was Oasis, 126%. ExxonMobil, 9%. Shell, 9%. So that's that to give you an idea, you have everywhere. And so, something should come out of you. Well, why is someone like Exxon only at 8% when oil's up 11%? Well, the answer is simple. Exxon has diversified itself to the point where it's not as reliant on oil as some of these other pure oil operators. And so when you look at the top of the list of who gained, so you're going to see a lot of just pure oil and gas shale companies, because they are more reliant on, the only ways they make money are oil revenue. And you can go look at 10Qs. Excuse me, you go look at a 10Q. There's like 3 ways oil companies make money. They borrow it, that's one. They sell oil, or they hedge. There's 3 ways. You borrow money, you make money selling oil, and natural gas, we'll throw that in there. And then 3, hedging. And you're either giving up money because oil went up and your insurance, you had to pay a little bit more for your insurance, or you're getting paid because oil tanked and all these hedges are paying off. So it's pretty simple when you break it down. There's not 65 different businesses that are bringing you money in these shale operators. At something like Exxon, yes. So that's why they're less dependent on oil. But, so I just want to give you, I want to read you a quick list here. These are the biggest gainers on Friday. And I want to tell you, can you give me something that they all have in common? Oasis, right? Chesapeake, Callan, QEP, Whiting, Extraction. I'm telling you, these are 6 of the top 7 movers. So what do they all have in common?
Do I get a multiple choice? Like they're all in trouble?
Yeah, well, they're not all in trouble. They're far beyond all in trouble. If that's what you're thinking, wait, why if you're thinking at home, wait, didn't Whiting declare bankruptcy? Yeah, no, you're right. They did. And they're up 62% on Friday. And so why are all these other companies grouped? Extraction. I mean, look at Whiting's in between QEP and Extraction. Well, what do those 2 companies have in common? Kind of on the brink of bankruptcy. Oh, look, who's just above them? Callan, probably on the brink of bankruptcy. Who's above them all? Chesapeake at a cool 76%. I'm not breaking any ground here when I say they're going under soon. Like if you don't think Chesapeake, I'm not breaking any new ground here. So Oasis, the biggest player, they should have declared bankruptcy 6 weeks ago. Like it's crazy to think that. And so what's crazy about this is when you look at Friday, this list is a bankruptcy list. You start looking at the biggest things, like this is the list of the companies that were about to go bankrupt. CRC, California Resources Corporation, they're out and they bought all of old Chevron's old California stuff and are now the biggest player up there in Bakersfield. 34%. There's been multiple stories we ran on the closing bell where they have reached out to advisors in order to advise them through Chapter 11. So considering it, and
Michael,
just,
your opinion. What is your opinion? Because this $40 oil cannot be a fibrillator for these companies. What are your thoughts on that?
Well, I was just about, I think it's, you bring up a good point, because what I think this means and why you saw all of these companies, I mean, Oasis, Chaparral, Cowan, QB, Whiting, all these companies that it's like, wow, they all were considering bankruptcy. CDEV was up huge. High Point's up big. Occidental, CRC, all of these companies that, like, what's going on? What do we think is going to happen? They all rose huge, while companies who are solid, Exxon, the Shells, the Integrates, they didn't move much. Well, the answer is, I think, twofold. One, obviously higher oil means bigger, but I think what this means is that we're starting now to get into levels 37, 38, 39, $40 oil, at which I think analysts on the equity sell side think that all of these companies that I mentioned may not have to do Chapter 11, may be able to stave off, may be able to produce enough oil revenue, because we mentioned there's only three ways you make money. You borrow it. That's not happening right now. Pretty hard. I don't think any bank is loaning Oasis money right now. But who knows? I don't know. I'm not involved with those negotiations. Oil revenues is the second, and that's what all I think this wraps up into being, is that the biggest movers, the top half of this list, I encourage you, go look at the biggest movers. I'm not making any of this up. I'll link the link that I use for the closing bell in the show notes. So you can just, boom, take a click. And I'm not making any of this up. You can go see who the biggest movers. It's a bankruptcy list. And this list basically is telling you, okay, these are the companies we thought were going to go bankrupt at lower oil. Now that oil has moved and been on a complete 2-week bull run, followed by Monday or Friday, culminating in a huge 3-5% rise, now we're getting to the levels where some of these companies considering Chapter 11 might not have to anymore, and might just be able to stave off bankruptcy, which, depending on what stakeholder, there's numerous stakeholders. Depending on where you fall in stakeholders, it's a good or bad thing. If you're an employee of those companies, it's a good thing, because you might not, if you've survived this far and haven't gotten laid off, you're probably not getting laid off now, because oil is going to continue to rise. If you're a debt holder, you're sad. Not sad per se, but you probably were just wanting a rebrand. I mean, I guarantee there were some debt holders out there, like specifically one Carl Icahn. We all know who he's heavily invested in. He now owns 3 of the 10 board seats. You could put 2 and 2 together what company I'm talking about. But basically they just want, the debt holders, they very well might want rebrands. They might want it to tank. Let's just Chapter 11 this. I want to come out with even a bigger stake. I might have lost some money on the investment, but if I come out with more equity through Chapter 11, it's kind of a win-win for me. So there's this interesting dynamic that's going, and so in terms of what this means, I would avoid any stock that was up more than 40% on Friday, and even 40%. I might say 35%. And remember, we don't give investment advice. On this show, but just avoid them, please. I mean, that list we led was just, avoid them. That's all I'm going to say. I would highly recommend, if you're looking to long-term trade these guys, yikes. I mean, you need to wait to see oil stabilize a little bit, because any drop, you're going to see these do the exact opposite. If oil all of a sudden drops to $20, you're going to see Oasis go a negative 150. You're going to see a reversal of this list, and it's going to be right back in the same position. So, Friday's bull run, while great for the oil business, it'll be very interesting to see. And it sort of is, it's kind of a weeding out process. I think it gives a clear picture of, if you want to know the companies that the big boys, the big analysts, all the big traders think are in trouble, there it is. It's just, it happened Friday. They separated the sheep from the goats, or, whatever that analogy is. So, Stu, I think I've gotten all I need to say. Is anything on this topic that you need to get out before we move on to some of the stuff that's going on this week in oil?
I think it's going to be kind of interesting on the fibrillator effect there, if it does get them some extra legs. But putting them in instead of the day trader, but the minute trader group will be pretty interesting.
Yeah, and I mean, from a research perspective, I'm not investing any money in those companies that I read off. I mean, just it's going to be tough in terms of a long term. Short term, you make money on anything in the short term because I'm a day trader. I think short term, I think 25 seconds. So I don't think in 25 seconds Oasis is going to go bankrupt on Monday. So you can trade them on Monday. Do I think you should hold them in your portfolio for 6 months? No, I don't think you should do that. I think if you have any of these things, you should exit quickly. And if you decide to get into them, you should know what your exit strategy looks like. That's the key on that one. So, do what you want. Again, we don't give investment advice. But you know who does give investment advice? Equity sell-side researchers. So if you want to know what their recommendations are, just go Google equity sell-side energy equity sell-side research, and you will find a plethora of Wells Fargo Securities, Bank of America Securities, all the big banks. They get the correct brokerage licenses. They get all the FINRA, all the stuff that, the regulation side, SEC regulate to actually give you a prediction. It's so funny. You read these sell-side research reports, and they're 4 pages long. 3/4 of the page are research. 3 1/4 of the pages are all the regulations and all the disclaimers they have to have on there. It's unbelievably funny how these templates run. So I think with that, it's time to just move into the week that's upcoming in oil. And as always, this segment is sponsored by Sandstone Capital Group. These guys do insanely good research, and all of the research you find on this podcast is from their Energy Glimpse solution. I can't say enough good things about these guys. Just give them a call, 949-561-1818. Or go to sandstonecg.com. Ask for Michael. He is an awesome guy. We love him. Really, when we look and we move into this week for oil, there's a couple things that I'm looking for. First, as we record this, I think it's time. It's smart to talk about Hurricane Cristobal because if you're listening to this podcast tomorrow morning, it's probably going to have passed. So we're going to know a little more about what maybe some of the effects are. But right now, as we record this, here about 1:30 Mountain Standard Time here on Sunday. Tropical Storm Cristobal is right over Louisiana and has caused about 600,000 barrels of oil to be shut in, which is about 33% of the crude oil production in Mexico right now. There's about 853 MCF of natural gas. BP ramped down production in about 3 platforms. Actually, had a buddy who got evacuated from that, so it's good to see he's all right. They've also removed some non-essential staff from before. The Oxy shut in all of its production, and they removed all personnel from its central and eastern Gulf Mexico facilities. Shell, Exxon, and Chevron all sort of waiting it out right now. They've only removed some potential staff. Louisiana Offshore Port, who is is one of the big takers in of all this offshore pipeline stuff, they've suspended all of its operations at its oil terminal. So that corresponds with about the 33% that's been shut off. Vessel activity has really calmed down. So everything's sort of waiting out right now. Everyone was able to get out of the way in time, so that's good. Hopefully we don't see any fallout from that. But if you're listening to this and it's still going on, we hope you got out of there just in time. The other thing that I had on the U.S. shale side to sort of watch for coming up this week is Blackstone on Saturday agreed that they're going to sell actually some Permian acreage. And so this is, you want to talk about debt biting somebody in the backside. When a company like Blackstone, who's running their minerals, is selling tier 1 to 2 Permian acreage. I mean, maybe not the best, but selling some Permian acreage solely to pare down debt. That's when debt is becoming a big issue. And circling that up to our talk, one of the biggest research points that you want to look at if you're looking at a company is how much debt do they have? The more debt they have, the bigger likelihood they're going to end up in insolvency, or something's going to have to happen, whether it's they get bought out or something. So when you talk about you're selling prime acreage just to pay down debt, I mean, they're looking to get acquired and become just a little more attractive. The other thing is, there's been some rumblings of a really big super major coming out and doing some M&A deals here very soon on what was once considered another super major. So we're going to be following a story here very quickly. We're not quite ready to go to press yet, as we call it, but we're going to keep you updated on everything. Stu, what is going on the international news desk side?
Well, boy, we got a couple things that are interesting. OPEC, I think everybody knows, OPEC Plus met yesterday. They did agree to another month extension on their cuts.
I just want to pop in. That's another reason. That's another factor that you can bake into Friday's huge bull run was the extension of those cuts.
That is correct. But another article I put out this morning from World Oil, they also are saying that this meeting also had some other new changes to the
Okay.
way they're calculating oil, and I've got to understand that a little bit more. So two-pronged approach from OPEC plus.
Interesting.
A
Yeah, we'll have to be following that story. Very. Yeah.
Yeah, I don't know the ramifications of the new rules. So I
Mhm.
think whenever they change rules, it's for their own benefit. So
Yeah, I mean, because we do know that they pulled back. I mean, remember they slashed their actual selling price from China, right? Right, back on March 8th. They brought it down to like it was like $20. So maybe they're bringing that. Maybe they're thinking of bringing that official selling number back up instead of on top of actually ramping production. Who knows? That's just a guess. I don't
I'm going to find out what more
know.
rule
Yeah.
amendments they have. I think it's pretty amazing. On Friday, Michael, if you remember, we had a discussion with Venezuelan tankers coming in, and there seemed to be something fishy. You asked me what I thought about having Chevron's tankers being held up. Another article came out today, and I hate being right, but there is even more oil companies that are avoiding sanctions by simply putting them under different contracts. They're starting to do some heavy investigation. That story's on there as well too.
You ran that on Friday, and it's kind of shocking, specifically that it's a super major. I mean, you're talking about these companies that do tank. I mean, these are the big boys. They don't necessarily need to be maybe doing this. It's interesting to think about. So we're definitely gonna be
It's,
following it.
I mean, do they need profit that bad that they have to shuffle off um, uh, tankers and things to a holding company? I don't know. Anyway, I had a couple other stories, and I thought this was really interesting. The inventor of the wind turbine is now trying to harness unlimited power. I found this one
Okay.
very interesting. The wind turbine inventor is now coming out with floating wind farms,
Oh, interesting.
um, and it's designed for deep water so that you're not having to use shallow water. And I don't know how the technology will work on that, but you throw a strong wind at it, and I'm not sure how it'll stay. But anyway, the other one out of
Yeah, it'll
Norway.
be interesting to see the transportation method behind it because that's the problem with offshore wind is okay, you can put it so far away. Yes, there's a lot of wind up in the middle of the ocean, but how do you pipe that back to where we need it? That's, I mean, the
Oh, it
biggest
gets all
problem with all this
expensive.
stuff is transportation.
And I don't know, but I'm going to follow that one. The one that really caught my eye was up in a Swedish company. They are putting up right now a wooden tower made out of renewable wood. And as you and I have had guests and authors on the show, um, there is a very high CO2 and pollution output with wind farms and the amount of steel, carbon fiber, all of these kind of things. And if you can make a tower, cut the weight down, cut the transportation cost down, make it out of renewable materials, you're going to start getting my attention. And I'm going to start going, well, now if you can make the blades renewable, now you really got my attention. But this is another wind story to keep an
Interesting.
eye on. So they're if they can pass the tests, they are going to start making. They already have, believe, 100 towers sold if they can pass the structural test.
Oh,
Thought it was
interesting.
pretty.
That's going to be a huge field.
Oh, absolutely. So especially, you know, people say green, renewable. It is not always green and renewable. It takes um, so much CO2, so much pollution in order to get a wind farm. The It's just some green is not always green.
It just comes back to the value chain proposition is, yes, maybe something in its current state is renewable, but look at the entire process to get there. I think that's just what a lot of people. I look out because I got trained as an economist. You're come, as we say, hell or high water. You are just trained to think that way. What is the full life cycles? I just think I've lucked out in that capacity where I've just always, I think of everything like that. It's almost sick.
It's like Alex Epstein and Gregory Wrightstone. The market-driven, use whatever's best in order to elevate people out of poverty. That's what it's all about. Use market-driven, whatever's best, and ecologically friendly. That trifecta is what we need to use.
And they all have to work in a balance. And this is another thing you learn as an economist, that there's clearly some level of pollution we're okay with in order to have an improved society. I mean, you make that choice unconsciously every single day when you get in a car and you decide, I'm going to drive to work versus walk. Well, you're putting CO2 in the air. You make that decision when you take a hot shower versus a cold shower. So I mean, you unconsciously make those decisions it's worth it for me to have this current benefit and have this small associated cost. I mean, it's just costs and benefits. I know it's, we always, economists get that rap where everything's just supply and demand, cost benefits. Well, you can boil a lot of things down to just what is the net change going one way or the other. So I'm all in on that. The only other thing that I had, I just thought was interesting for the international news desk was this just came across the news wire that we all know Guyana is the big discovery that's going on right now. Exxon's got the biggest field, that Liza 1 project, which is on that Stobroke block, which is woohoo. They're thinking 120,000 barrels per day peak production just out of that block. So I mean, you want to talk about profitability. What the problem is, it's actually plummeted though. They've had some compressor problems, and they've had two things. One, compressor problems. Two, the Environmental Protection Agency has not granted them a flaring permit above 15 million cubic feet of natural gas today. So they're only doing about 25,000 barrels per day because they can't quite get enough flaring permits from the EPA, and they're having some weird compressor issues. So timely, as we don't necessarily need the oil on the market right now, but long term, you're going to have to, along with that ESG stuff, EPA is going to come in and be saying some of this type of stuff. If they're already getting them off the offshore Guyana, they're coming for onshore very quickly.
One of the things on that Guyana field is they were trying to tap in, just like we have so much flaring in the Permian. They were trying to tap in to use that offshoot rather than flare it. I'll have to go look and see where they were on that one.
Yeah, I mean, it's everyone talks about we'd love to produce our own natural gas, pipe it in, and convert it, but everyone just ends up applying for permits because it's cheaper anyway. It's just sometimes it's cheaper, it's too costly, especially now when there are, going back to segment 1, if you do some of the sell side research, I mean, it's not a rosy outlook for the industry. Let's just say that this is not the industry. If you came to me and was like, yo, I had $100,000, I'm not necessarily putting any in the energy side. Who knows? Again, we don't give investment advice here. We just sort of tell you what it is. I think that's everything on the news side, though. Before we move into the levels, anything people need to be watching for this week, news-wise, coming up?
Well, more on the tanker situation.
Yeah, that's a big thing.
Even though we have shut-ins, I'm going to be curious to watch the offload rate of the VLCCs and the storage coming in, just to see that level coming in. The other one is, President Trump offloaded or made it easier for some folks to get projects done early and easier and through. There's a fight going on in New York right now about a pipeline from the Marcellus to New York City, and that would help eliminate Russian imports. So that'll be one we're going to be watching, that fight.
No, we'll definitely be covering that one, and that is good to see. When we move into sort of just the levels for crude oil for the week, we're in unprecedented territory. You have to pretty much go back to 2015 to find any volume in between $41 and $38 or $37. So anything that's going on right now is just a guess in terms of levels. So I'm going to avoid giving you levels and just say my bias is switched to the bull side. I don't fight the current. I like to swim with it. And you just, when you look at everything from where where your VOCs, which is our volume point of controls, where they have moved over the past 2 weeks. If you just look at structure from a price action standpoint, it's bull. I see no reason to slow it down. I mean, do I think we're going to see $45 oil next week? No, but I do think we're going to see 40. I mean, we're sitting only 55 cents away. By the time someone might be listening to this podcast, I guarantee, not that I guarantee, but it'll probably be $40. So I think it's reasonable to suspect that. I think $41, $42 is probably the cap for this week. But then again, I'm always wrong. If from my side, I'm bullish this week, but if I'm looking to get in at a level, I'd love $37.50 to $38 as an entrance point for a long. You might see some overnight depression. Who knows? Maybe the market isn't as satisfied with the production cuts that OPEC wants. I mean, we're going to see a market's going to open in a little bit. So if there's any crazy things that happen, we might have to just reshoot this. But from where we're sitting here right now, I think the market expected the production cuts to continue through. I don't think people were thinking, at least traders weren't necessarily thinking, oh, the cuts aren't going to be extended. So I think they think they're going to be extended, which means they're priced in. So I don't think you're going to see just a massive run up. I think what you would have seen is if they didn't extend the cuts, there would be a massive offsuit. But I don't think that is. But I do think you're going to see a depression. I like to get long, but I'm looking at that 37.50 to 38 range in terms of a nice level to catch something maybe to the upside. When you look at COTs, hedge funds got long, as we mentioned. Hedge funds have been doing long for 2 weeks. The COT, which is our commitment to traders, which basically gives you a nice overview of what the professionals and the hedgers are doing in this space. Longs on the short side for producers and swaps got slashed, so that's basically means insurance is getting picked up on the short side. So producers are using these lower premium times to do what they should have done 9 months ago and bought in protection. So they're finally buying their protection right now. We have an article that you should be able to see with Aegis Energy Risk. We got a little tap in to their internal market analysis. And they had some really cool stuff on. They're seeing a lot more hedging activity pick up right now because these lower premium insurance rates. I'm looking at them right now. I mean, you can pick up, some October options for $4,000. I mean, you can lock in 10,000 barrels for about $4,000 in terms of, $30 put. I mean, you can get them for about $4,000 a contract, which if you know what that number means for hedging, that is cheap, baby. You're losing money not buying that. So you can check out, if you do have any hedging questions, I highly recommend checking out Aegis Energy Risk. They do a great job with all this. So that's a free plug. You don't even pay us for that. And we're just free plugging people. But if you are looking at the hedging side, the commitment of traders is showing it. And when you look at the options table, and I've got it pulled up right now, it's cheap. It's not going to necessarily get much cheaper than this. So if you were thinking as an operator of getting in on maybe picking up some protection, taking some risk off, please, now is the opportunity time to do it. I just messed up that word. What was that? Opportunity? I said it right. Opportunity, whatever. That's all I've really got for crude oil. I think we've covered what's coming up next week. Like I said, I think I'm bullish moving in. I don't think $42, $43 is about the cap. Like I said, it'll be interesting to see what happens, as the week goes on. As always, we will be covering everything on a daily basis on our digital ticker show, which airs live on YouTube. Stu, before we go check into the 360 fund, you got anything?
No, you covered it all.
Well, good. So, like I said, I think it's time to move into the 360 official, non-official fund. But before I do this, as always, the lawyers make us say this so we don't get sued. This segment is for entertainment purposes only, and everybody on this show, i.e. me, Michael Tanner, Stuart Turley, invest for our own account and do not manage any outside money. We do not give investment advice. We do not offer any outside money, and we do not give and we're going to have no involvement with the regulated side of the industry. Remember, investing is risky, and you can and will lose your entire principal. That being said, Stu, how's your side of the portfolio looking?
Well, I got blindsided totally by the numbers on the employment. Very happily, yep. I might add.
No, yes, I agree.
Very, very happily. Now, that being said, I'm back into Oxy. You never know how some of the majors are going to be playing in that area. Oxy's up 33.7.
I like that. I like that a lot. I know they were in that list of
yep.
high movers. So you might be thinking, well, Michael, you just said that, they was in that list of bankrupt companies. Well,
Right.
you have to look at every company individually. Just
All the
because most
technicals.
of those companies are going to go, but doesn't mean they all will. And I think if you're
Right.
picking and choosing out of that top list, I think you've chosen correctly.
I've chosen wisely according to my
Kreskin, amazing Kreskin, Oxy was correct.
Okay. Also have Rattler and FLNG and back into
Rattler's been a winner for you. Rattler has been a huge winner for you.
Rattler's been rock solid and just got into.
That's and just for everybody listening, that's Diamondback's midstream company, correct?
That is correct. Midstream is holding tough. It is almost like it's outside the oil industry, and
you want to know something? You just an interesting fact about midstream companies is I was doing some research for the first segment this morning, and I just looked up free cash flow and sorted all of the companies. All of the top free cash flow companies, they're all midstream companies. They're all midstream companies, and they make a buco bucks on a free cash flow basis. So if you do if one of your metrics is free cash flows for long investing, you gotta love the midstreams.
Well, the Sopranos were made from the midstreams. Do you know that?
Really?
Yeah. Hey, you want your oil moved?
Okay, I love it. How's Tomcat doing? Is he still? He was bought. I don't think he saw
feeding.
Did he see this coming?
He did not see this one coming either. He's having to reassess his short-term portfolio. So
well, I think everyone's getting a little.
Update.
I think everyone's getting a little spooked by this. I mean, Bonanza Creek has done very well, sitting at $19. I mean, we're up 2,000 on Bonanza Creek, which is great to see. Natural gas is about the only thing lagging our portfolio down a little bit. Like I said, sorry. Go ahead, Stu.
My Cheniere's up.
Oh, okay. But yeah, no, natural gas equities, I think, are doing much better than actual natural gas, because natural gas right now isn't moving, but the expectation as we move into the winter season with all of these supply issues and these shut-ins is that natural gas will rise in that, because we know natural gas is cyclical. So it's cyclical in terms of, during the draw season, which is the winter, prices naturally rise. During the build season, when we build up stocks, we see it. And you can actually see it very clearly in the California oil production, because some of the top natural gas producers in the summer are all storage companies producing, and they're literally called California storage companies. And then they literally have names like that are companies storing natural gas, and then in the winter they go away. So it's sort of funny how you see them produce up and then boom, shut in. You don't see their names for 4 or 5 months. They go into nice bear hibernation. But so we really like that. I'm looking to get in long for crude oil, but I like the 37 level better. I think we're not, who's to say what's overvalued or undervalued right now, but I like it at that 37 level. So that's what I'm looking for, a little bit of a pullback when you just look at the structure of the way things have set up. I like the volume chunk there, but really I'm bullish on oil for the week. So if you're looking to do some trading specifically on crude oil futures, bias bull, that's just what I think the research is showing. So I think that's everything, Stu. We're over 45 minutes. We're about 45 minutes here. We've chatted these guys' ear off enough. Is there anything that we need to get? Anything we got left before we let these guys get out of here back to work?
Buckle up, get a flight suit. It's going to be a rough ride.
Yeah, or fun, depending on how you look at it. So I'm a glass half full guy, and I'm having a blast doing this. So we appreciate you guys checking out the show. Please, again, just subscribe, 360 Digital Closing Bell, iTunes, Spotify, or Entercom's YouTube page. We're going to go ahead and let you guys get back to work. Thank you for checking out the 360 Digital Closing Bell. We will see you this afternoon for the Digital Ticker.